37.6 trillion. That's the official debt of the United States government as of September 2025. But here's what nobody's talking about. When you add in the unfunded liabilities for Social Security and Medicare, programs that Americans have been promised, that number explodes to 103.2 trillion. To put that in perspective, the entire global GDP is approximately $100 trillion. The United States has accumulated obligations that exceed the economic output of the entire planet. This isn't speculation. According to the Wharton budget model from January 2025, the complete measure of federal indebtedness, including unfunded Social Security and Medicare Part A obligations for people living today, stands at $103.2 trillion. The Congressional Budget Office projects that federal debt held by the public will rise from 99% of GDP in 2024 to 116% by 2034. But here's what makes this time different. This exact pattern has played out before. 3 times in the last 500 years, dominant global empires followed an identical 7-stage collapse sequence. Spain under Philip VI defaulted 4 times in 40 years. Britain lost its reserve currency status and a quarter of the Earth's surface in 3 decades. The Soviet Union went from superpower to rubble in less than a decade. The pattern is identical. Dominance, overextension, deficit spending, currency debasement, inflation, loss of confidence, collapse. And the United States is currently exhibiting the characteristics of Stage 5. Stage 5 is inflation combined with loss of confidence in institutions. It's the stage where the dollar's share of global reserves falls from 71% to 58%. It's the stage where your government debt exceeds 124% of GDP, while your military spending reaches 3.4% of GDP, maintaining 750 bases in 80 countries. Let me show you exactly why the United States cannot escape what destroyed every empire before it. To understand why the collapse pattern repeats, you need to understand what an empire actually is from an economic perspective. An empire isn't just military conquest. An empire is a system where one nation extracts resources from other nations through control of trade routes, enforcement of currency standards, and the ability to export its inflation to the rest of the world. Think of it like a business that stops producing goods but stays profitable by controlling the payment system. You don't manufacture products anymore. You just take a cut of every transaction. That's what reserve currency status provides. When the dollar is the global reserve currency, approximately 88% of all foreign exchange transactions involve dollars according to the Bank for International Settlements. That means the United States can print money and export the inflation to every country that holds dollars. Here's how it's supposed to work. A country becomes dominant through productivity and innovation. Its currency becomes trusted because it's backed by real economic output. Other countries hold that currency in reserves because they need it to buy oil, pay debts, and conduct international trade. The dominant country benefits from what economists call exorbitant privilege. It can borrow at lower interest rates because global demand for its currency is high. It can run deficits that would destroy other nations because the world needs its currency. But here's where it gets dangerous. That privilege creates a trap. When you can print money without immediate consequences, when you can borrow without immediate pain, the incentives reverse. Instead of maintaining the productivity that created dominance, you rely on the privilege itself. Military spending increases to protect the system. The government expands to distribute the benefits. Deficits become permanent because there's always a buyer for the debt. The scale matters. According to the Federal Reserve's 2025 report, the US dollar comprised 58% of disclosed global official foreign reserves in 2024. That sounds stable until you realize it was 71% in 1999. The dollar has lost 13 percentage points of reserve status in 25 years. For comparison, Britain's pound sterling went from 81% of global reserves in 1945 to 58% in 1950. Just 5 years. The decline accelerates. Let me show you the exact mechanism. When Spain controlled silver from the Americas in the 1500s, it could fund wars across Europe. When Britain controlled maritime trade routes, it could finance an empire covering a quarter of Earth's land surface. When the Soviet Union controlled oil and satellite states, it projected power across half the world. Each time, the empire expanded beyond its productive capacity. Each time, it tried to fund that overextension by debasing the currency or accumulating debt. Each time, the same 7 stages unfolded. What makes this pattern so reliable is that it's not a political cycle or a cultural phenomenon. It's mathematics. An empire reaches a point where maintaining the system costs more than the system produces. The productive core shrinks while the extractive apparatus expands. Debt compounds. The currency that once represented real wealth becomes a claim on diminishing productivity. And then the confidence breaks. Here's what you need to understand. Every dominant empire believes it's different. Spain believed New World silver made it invincible. Britain believed industrial supremacy was permanent. The Soviet Union believed central planning had solved the business cycle. They were all wrong for the same mathematical reasons. Let me show you what happened in Spain between 1556 and 1598, when Philip II of Spain inherited what seemed like an unstoppable empire. Spain controlled the silver mines of Potosi in modern-day Bolivia, which produced approximately 80% of the world's silver. The Spanish Empire stretched from Europe to the Americas to the Philippines. It was the dominant military power. Its currency, backed by precious metals, was the reserve currency of international trade. But Philip II inherited something else. His father, Charles V, left him with a debt of approximately 36 million ducats and an annual deficit of 1 million ducats. To put that in perspective, the entire annual revenue of the Spanish crown was about 5 million ducats. Spain's debt-to-revenue ratio was more than 7-1. Here's what happened next. Spain was fighting simultaneous wars. The Dutch revolt starting in 1566 required constant military spending in the Netherlands. Wars against the Ottoman Empire in the Mediterranean drained resources. The English raids on Spanish shipping disrupted silver flows. And maintaining the vast administrative apparatus of the empire consumed money faster than silver could arrive from the Americas. Philip II tried to finance this through borrowing. Genoese bankers, the equivalent of today's major financial institutions, lent Spain money at interest rates that eventually reached 40% for short-term loans. The Crown borrowed against future silver shipments. When the silver arrived, it immediately went to pay interest and principal on existing debts. The government was borrowing just to service existing borrowing. Then Spain started debasing the currency. The Crown issued copper coins called velón and declared by decree that they had the same value as silver. According to economic historians, between 1599 and 1650, Spain diluted its currency systematically. Prices in Spain increased by approximately 500% during Philip II's reign as inflation destroyed purchasing power. The cascade was predictable. Spain defaulted on its debts in 1557, just 1 year into Philip II's reign. It defaulted again in 1560, then 1575, and finally 1596. The 1575 default was the largest, rescheduling approximately 14 million ducats in debt. Each default temporarily relieved the Crown's cash crisis. And each time, incredibly, the Genoese bankers came back. Why? Because they believed Spain's silver would eventually cover the losses. They were wrong. By the 1590s, silver production at Potosi began declining. The cost of extracting silver increased while the yield decreased. And all that silver that Spain had extracted for decades? Almost none remained in Spain. It flowed immediately to creditors in Genoa, Antwerp, and other financial centres. Spain became a conduit for wealth extraction, not a wealth creator. The real economy collapsed. Agricultural production fell as rural areas depopulated. People moved to cities seeking employment in imperial administration or military service. Spain imported grain from northern Europe, paying for it with the silver that should have built domestic industry. By 1600, Spain was economically hollow. It maintained the appearance of empire while producing almost nothing. The military consequences came quickly. The Spanish Armada, sent to invade England in 1588, was destroyed. Spain lacked the financial capacity to rebuild. The Dutch rebels, whom Spain had been fighting for decades, effectively won independence by the early 1600s. The empire that had seemed invincible in 1556 was effectively finished by 1640. But here's what makes today even more dangerous. Philip II's Spain defaulted 4 times in 40 years. Each default took years to resolve through negotiation with creditors. Today's financial system is interconnected in ways that didn't exist in the 1500s. When Spanish debt defaulted, it affected Genoese banking houses and Spanish creditors. When modern sovereign debt defaults, it ripples through the $710 trillion derivatives market in microseconds. The contagion doesn't take years to spread. It takes minutes. Spain's deficit spending was 20% of revenue. The United States deficit in fiscal year 2024 was 6.7% of GDP with debt at 124% of GDP. The mathematics is actually worse now. Let me show you why. Today, in November 2025, the United States federal debt stands at $37.6 trillion. To put that in perspective, US GDP is approximately $28 trillion. The debt to GDP ratio is 124% according to CEIC data. That means the United States owes 24% more than the entire economy produces in a year. But that's only the beginning. The official debt number doesn't include unfunded liabilities. Social Security has an unfunded liability of approximately $63 trillion over a 75-year projection, according to the 2024 OASDI Trustees Report. Medicare Part A has an unfunded shortfall of $15.1 trillion. Medicare Part B, the largest liability, has an unfunded $99.5 trillion a shortfall, according to Open the Books analysis from March 2024. That's $175.3 trillion in total unfunded obligations. The complete measure of federal indebtedness, including unfunded Social Security and Medicare Part A obligations for current beneficiaries, reaches $103.2 trillion according to the Wharton budget model from January 2025. For context, global GDP is approximately $100 trillion. The United States has promised more than the entire economic output of planet Earth. Now, let me break down who holds the risk. According to the Treasury Department, approximately $27 trillion of US debt is held by the public. Foreign governments hold approximately $8 trillion of that. Japan holds about $113 trillion. China holds approximately $821 billion, down from over $1.3 trillion just a few years ago. China has been systematically reducing its holdings of US debt while accumulating record amounts of gold. But here's what you need to understand about concentration. The US banking system holds enormous exposure to government debt. According to Federal Reserve data, commercial banks held approximately $4.4 trillion in US government securities as of mid-2024. When interest rates rise, the market value of those bonds falls. This is what triggered the March 2023 banking crisis when Silicon Valley Bank collapsed, holding $91 billion in assets but facing $42 billion in unrealized losses on its bond portfolio. The leverage ratios are staggering. Major US banks operate with capital ratios around 10 to 12% of assets. That means $1 in capital supports approximately $9 in assets. If those assets lose 11% of their value, the bank is technically insolvent. And those assets include massive holdings of government bonds whose value is inversely related to interest rates. Here's where the interconnection becomes dangerous. The derivatives market has a notional value of approximately $710 trillion according to the Bank for International Settlements. That's roughly 7 times global GDP. These derivatives include interest rate swaps, currency swaps, and credit default swaps that reference US government debt. The standard argument is that these are hedged. Bank A holds a swap with Bank B that offsets exposure to Bank C. Net exposure is supposedly limited. This is catastrophically wrong. Here's why. Hedges only work if counterparties can pay. If Bank B fails, Bank A's hedge disappears, but its exposure remains. This is exactly what happened in 2008 when AIG couldn't pay on credit default swaps. The hedged positions revealed themselves as naked exposure the moment a counterparty failed. The government had to inject $182 billion to prevent AIG's collapse from cascading through the system. Compare the scale then to now. In 2008, the crisis centered on approximately $1.3 trillion in subprime mortgages. The derivatives referencing those mortgages had a notional value of perhaps $50 trillion. Today, US government debt alone exceeds $37 trillion, and the derivatives market has grown to $710 trillion. Now consider the military dimension. The United States spends approximately $842 billion annually on defense, according to the Department of Defense request for fiscal year 2024. That's 3.4% of GDP. For comparison, this is approximately 40% of total global military spending according to SUPRI. The US maintains approximately 750 military bases in at least 80 countries. This is stage 2 of the collapse pattern: overextension. The cost of maintaining global military dominance exceeds what the domestic economy can sustainably support. Every carrier strike group, every overseas base, every forward deployment requires funding. And that funding comes from borrowing. The United States government borrowed approximately $1.8 trillion in fiscal year 2024 to cover its deficit. That's borrowing $5 billion per day. And the cost of servicing existing debt is accelerating. In fiscal year 2024, interest payments on the national debt exceeded $1 trillion for the first time, making it one of the largest line items in the federal budget. This is stage 3. Deficit spending becomes structural. The government cannot balance the budget without cutting either entitlements or military spending. Both are politically impossible. So the deficits continue, compounding the debt, increasing the interest payments, creating a spiral that mathematics alone makes inevitable. Let me give you a specific example of how this pattern destroys the middle class. You're 32 years old in 2020. You have a college degree and you're making $60,000 per year in a mid-level professional job. You're saving approximately $800 per month. Your goal is to buy a house. In your area, the median home price is $320,000. You need a 20% down payment, which is $64,000. At your savings rate, you'll have the down payment in approximately 6.5 years. Then the government's response to COVID-19 hits. The Federal Reserve expands its balance sheet from $4.2 trillion in March 2020 to $8.9 trillion by April 2022. That's $4.7 trillion in new money created in 2 years. The federal government spends approximately $5 trillion on pandemic relief programs, most of it borrowed. By 2022, inflation reaches 9.1%. Prices are increasing across the board. But here's what really destroys you. The median home price in your area goes from $320,000 in 2020 to $460,000 by 2023. That's a 44% increase in 3 years. Your required down payment just went from $64,000 to $92,000. You need an additional $28,000. But your salary hasn't kept pace. By 2023, you're making $68,000, an increase of approximately 13% over 3 years. After taxes and the increased cost of food, gas, and rent, you're now saving about $650 per month instead of $800 because your basic expenses have gone up. Let me show you the math. In 2020, you were 6.5 years away from your down payment. By 2023, you've saved approximately $25,000. But you now need $92,000 total. That's $67,000 remaining. At $650 per month, that's another 8.6 years. You've been saving for 3 years, but you're further from home ownership than when you started. You went from 6.5 years away to 11.6 years away despite saving for 3 years. You've moved backward. Meanwhile, someone who owned a house in 2020 saw their equity increase by $140,000 without doing anything. Someone who owned stocks saw the S&P 500 increase from 2,480 in March 2020 to over 4,500 by 2023. Someone who owned Bitcoin saw it go from $5,000 to over $60,000 in that same period. Asset owners gained hundreds of thousands of dollars. You gained nothing. This is the theft mechanism. It's not taxation. It's inflation caused by currency creation to fund deficits. The government borrows money that doesn't exist. The Federal Reserve creates it by expanding its balance sheet. That new money enters the economy and bids up asset prices. Asset owners benefit. People trying to save in cash are destroyed. And here's what makes it permanent. You can't catch up. Even if your salary eventually matches inflation, the asset prices have already increased. The homeowners who benefited in 2020-2023 now have equity they can leverage for additional investments. You have less purchasing power than you started with, despite working and saving for years. This is stage 5 of the collapse pattern. The inflation begins transferring wealth from wage earners to asset owners, from savers to debtors, from the productive middle class to those already positioned in the system. This is the stage where social cohesion begins to break down. Now let me show you the triggers that will push the United States from stage 5 to stage 6, loss of confidence, and ultimately stage 7, collapse. They're already appearing, and several will likely activate over the next 18 to 36 months. The most obvious trigger is interest rates and debt service costs. In fiscal year 2024, the United States paid over $1 trillion in interest on the national debt for the first time. That's approximately 3.1% of GDP just servicing existing debt. The current average interest rate on federal debt is roughly 3.3%. But as debt matures, it must be refinanced at current market rates, which have been significantly higher. If the average rate on all federal debt rose to just 5%, interest payments would exceed $1.9 trillion annually. That's larger than the entire defense budget or all of Social Security. When interest payments become the largest budget item, crowding out essential services, confidence begins breaking. The second major trigger is the dollar's declining reserve status. The dollar's share of global reserves has fallen from 71% in 1999 to 58% in 2024, according to Federal Reserve data. That's a loss of 13 percentage points over 25 years. But the decline is accelerating. BRICS nations are actively working to create alternative payment systems. China has been systematically reducing its dollar reserves, cutting US Treasury holdings from over $1.3 trillion to approximately $821 billion. When reserve currency status reaches a tipping point, typically below 50% according to historical precedent, the decline becomes self-reinforcing. Countries dump reserves because other countries are dumping reserves. This creates a cascade. Social Security and Medicare insolvency represents the third trigger. According to the 2024 Trustees Report, Medicare's Hospital Insurance Trust Fund will be insolvent by 2031. That's just 6 years away. Social Security's combined trust funds will be depleted by 2034. When these programs face insolvency, the government has 3 choices: cut benefits by approximately 21%, raise payroll taxes by several percentage points, or borrow trillions more. Cutting benefits will trigger political crisis. Raising taxes will suppress the economy. Borrowing more accelerates the debt spiral. There's no path that doesn't lead to crisis. The fourth trigger is already active: de-dollarization in energy markets. According to reports from 2024 and 2025, Saudi Arabia has conducted oil sales in currencies other than dollars, breaking the petrodollar system that has existed since the 1970s. China is purchasing Russian oil in yuan. India is buying Russian energy in rupees. When oil transactions move away from dollars, one of the primary sources of global dollar demand disappears. This reduces the need for countries to hold dollar reserves, accelerating the decline in reserve status. But perhaps the most dangerous trigger is the confidence cascade. Here's what you need to understand. These triggers interact. Rising interest rates make the deficit worse. The worse deficit requires more borrowing. More borrowing increases supply of treasury bonds. Increased supply lowers prices and raises yields. Higher yields mean more borrowing cost. And foreign holders of dollars, seeing yields rise and the dollar's reserve status fall, start reducing positions. That puts downward pressure on the dollar. Dollar weakness causes import inflation. Inflation forces the Fed to keep rates higher. Higher rates worsen the debt spiral. The specific trigger almost doesn't matter because the system is so fragile. It could be a major bank failure. It could be a failed treasury auction where there aren't enough buyers. It could be a geopolitical event that causes foreign holders to dump treasuries. Once any major trigger activates, the interconnection means others follow within weeks or months. The crisis is coming. The only question is which domino falls first and when. Now here's what you need to understand. When this system fails, there's no bailout large enough to stop it. In 2008, governments worldwide committed approximately $14 trillion to stabilize the financial system according to various estimates. The US government authorized $700 billion for TARP. The Federal Reserve expanded its balance sheet by approximately $2.1 trillion through various emergency facilities. That was roughly 15% of US GDP at the time. It barely worked. Major banks like Lehman Brothers still failed. AIG required $182 billion. The system came within hours of complete collapse. The federal debt today is $37.6 trillion. If just 10% of that debt faces crisis, either through default risk or refinancing failure, that's $3.76 trillion in losses. That's more than 5 times larger than TARP. And that's only the direct government debt. It doesn't include the derivatives market, the $710 trillion in notional value that references interest rates, currencies, and sovereign debt. Even if just 1% of that notional value converts to actual losses, that's $7.1 trillion. There's no mechanism to absorb losses at that scale. Governments don't have $3 trillion to $7 trillion available. The US federal government already runs an annual deficit of nearly $2 trillion. US debt is 124% of GDP. To borrow another $5 trillion in an emergency would push debt to approximately 142% of GDP. Bond markets would collapse from the supply of new debt. Who would buy that debt? Foreign holders are already reducing positions. Domestic institutions are already saturated. The Fed would be the only buyer. So the Federal Reserve could theoretically print the money. That's what it did in 2008 and during COVID. But that comes with catastrophic consequences. The Fed's balance sheet went from $870 billion in 2007 to $4.5 trillion by 2015. That expansion contributed to asset price inflation. Then during COVID, the Fed expanded from $4.2 trillion to $8.9 trillion. The result was 9.1% inflation, the highest in 40 years. Now imagine the Fed printing another $5 trillion to $10 trillion to bail out a sovereign debt crisis. That would expand the balance sheet to approximately $18 trillion or roughly 64% of GDP. For perspective, the Bank of Japan's balance sheet, after decades of monetary expansion, is approximately 120% of GDP, and Japan faces persistent economic stagnation. If the Federal Reserve went to 64% of GDP in a crisis, inflation would be uncontrollable. We're not talking about 9% inflation. We're talking about 20%, 30%, potentially hyperinflation depending on how quickly confidence breaks. The political will for another massive bailout doesn't exist. In 2008, the public was angry but compliant. TARP passed after initial rejection, and the system stabilized. That acceptance is gone. Trust in institutions, according to Gallup polling, is at generational lows. Congress's approval rating hovers around 20%. Media trust is below 40%. If the government announced a $5 trillion bailout primarily benefiting large banks and bondholders, while middle-class Americans saw their savings evaporate in inflation, the political system would face legitimacy crisis. There's also a mathematical problem with bailing out sovereign debt. In 2008, the government bailed out banks and companies. It purchased assets, injected capital, guaranteed deposits. Those are concrete actions, but you can't bail out sovereign debt the same way. The government can't buy its own debt at face value using printed money without creating inflation that destroys the currency. The debt is a claim on future government revenue. If that revenue is denominated in a currency being debased to pay the debt becomes worthless anyway. This is why no bailout is possible at the scale required. The mathematics doesn't work. The political will doesn't exist. And the mechanism of bailout, printing money to cover sovereign obligations, is the same as default through currency collapse. Either way, the system breaks. So here we are, sitting on top of a $37.6 trillion official debt and $103.2 trillion in total indebtedness, including unfunded liabilities. That is approximately equal to the entire economic output of planet Earth. Held primarily by a financial system that claimed 2008 was too big to fail at $1.3 trillion in mortgage losses, facing multiple simultaneous triggers, rising interest rates that have pushed annual debt service over $1 trillion, declining reserve currency status falling from 71% to 58% of global reserves, entitlement insolvency within 6 to 9 years, and active de-dollarization in energy markets, with no ability to bail it out if it goes wrong because the scale exceeds what governments can borrow and what central banks can print without destroying the currency through hyperinflation. Ray Dalio, founder of Bridgewater Associates, described the pattern of empire decline in his research on the big cycles over the last 500 years. He was right. The response to every previous warning hasn't been to reduce the debt, reform entitlements, or scale back military overextension. The response has been to accelerate borrowing, expand commitments, and debase the currency faster. The crisis is coming. It might start with a failed treasury auction, where there aren't enough buyers for government debt. It might start with a major bank failure triggered by bond losses. It might start with a geopolitical event that causes foreign holders to dump treasuries. It might start with Social Security insolvency forcing benefit cuts. The specific trigger almost doesn't matter because the system is so fragile that any major shock will reveal the insolvency that already exists. When the first domino falls, the cascade begins. Within hours or days, you'll see credit markets freeze. Banks will halt lending. Derivatives counterparties will fail to pay. The government will announce emergency measures, bank holidays, capital controls, treasury purchase programs. None of it will work. You can't bail out losses that exceed 100% of GDP. You can't print your way out of a sovereign debt crisis without hyperinflation that destroys the currency anyway. You can't cut entitlements to 65 million Social Security beneficiaries without political collapse. What comes after a $103.2 trillion debt structure collapses is unknowable in its specifics. But the pattern is clear. This isn't speculation. This is pattern recognition and basic mathematics. The United States has accumulated obligations in a system built on currency dominance. When that dominance breaks, everything breaks.